Imagine walking into a casino, right? You head straight for the absolute highest stakes table on the floor.
Okay, I'm picturing it.
You look the dealer dead in the eye and you announce that you're about to just throw away 17% of your chips.
Just straight into the trash.
Exactly. And you admit to the whole table that the game you've been playing has suddenly gotten, way harder to win.
Right.
You're confessing that you've been steadily losing ground to these, cheaper, scrappier players at the low-stakes tables.
Yeah, budget players.
But then, despite all of those massive handicaps, you somehow walk out of the casino with record-breaking cash. I mean, exceeding every single expectation the house had for you.
It sounds impossible. But that high-stakes player is Intuit.
It is. Yesterday, May 20th, 2026, they dropped their Q3 earnings report. And the headline metrics are, well, they're nothing short of a paradox.
Total paradox.
Right. Because they missed on total tax filings. They just announced they are firing 17% of their entire global workforce.
Which is a huge number.
Huge. And yet they absolutely crushed their earnings estimates. And get this, they actually raised their full year guidance.
Yeah, the initial market reaction to those headlines was, it was basically whiplash.
Oh, I bet.
Because when you see a massive workforce reduction combined with, a shrinking core user base, your instinct is to assume the company is in structural decline.
Right, you think they're sinking.
Exactly. But peeling back the layers of this specific earnings transcript, it reveals a ruthless, highly calculated masterclass in margin expansion.
Wow.
We are looking at a fundamental rewiring of a legacy software business here.
So welcome to today's deep dive. We are going to tear this earnings call down to the studs.
Let's do it.
I want to look at the raw data, examine the underlying mechanics of this strategic pivot, and figure out what this means for you if you're holding ticker symbol INTU in your portfolio.
And there's a lot to unpack for the retail investor here.
Absolutely. So let's start with the sheer scale of the top line revenue. The headline number that jumped out at me immediately is the $8.6 billion in Q3 revenue.
Yeah, that's a staggering figure for a single quarter.
It really is. We're talking about a 10% year-over-year growth rate on an already massive base.
Right. It's not a startup doubling from 1 million to 2.
Exactly.
Right.
Adding 10% to an $8.6 billion run rate in one quarter, especially in this current kind of weird macroeconomic environment, I mean, that requires some serious operational leverage.
It does. But, it also requires a business model that is largely immune to traditional consumer spending pullbacks.
Right, because taxes.
Because taxes. Yeah. Tax and accounting compliance, they aren't discretionary purchases. You can't just decide not to do them because inflation is high.
Unfortunately, true.
But even with that built-in advantage, beating Wall Street's consensus is one thing. Intuit exceeded the very top end of their own internal guidance across the board.
Which is wild.
And the profitability metrics are where the story really gets interesting.
Okay, hit me with the numbers.
So their non-GAAP diluted earnings per share, their EPS, hit $12.80.
Wow. Up from what?
Up from $11.65 in the same quarter last year.
Okay.
And on a GAAP basis, they posted $4 billion of operating income.
$4 billion. Let's translate those profitability metrics for a second for everyone listening.
Yeah, good idea.
Because the gap between GAAP and non-GAAP figures is a really crucial indicator of how a tech company actually operates.
Yeah, the whole ball game.
Right. So $4 billion in GAAP operating income means that after accounting for all the standard, generally accepted accounting principles,
which includes the hard costs of doing business, depreciation, actual salaries, all of that.
Exactly. After all that, they are generating a literal mountain of cash.
Yes, they are.
But the non-GAAP EPS of $12.80, that strips out certain expenses. Usually, in tech anyway, non-GAAP numbers exclude stock-based compensation and the amortization of intangible assets from past acquisitions.
And that distinction is paramount here.
Yeah.
Especially when you consider Intuit's history of, these massive acquisitions.
Like Credit Karma and MailChimp.
Exactly.
Yeah.
When they report non-GAAP EPS, they are backing out the accounting amortization of those multi-billion-dollar deals.
Right. To give investors a clearer look at the actual cash-generating power of the core business today.
Precisely. And the CFO, Sandeep Aujla, he was very deliberate in crediting their disciplined approach to managing those core operations.
What did he point to specifically?
He specifically pointed to continued, quote, AI efficiencies as a primary driver for keeping costs flat while top-line revenue expanded by 10%.
Ah, the magic AI words.
Always. But they are actually scaling the revenue without proportionately scaling the headcount or the operational overhead.
Okay, I want to challenge the core premise of that 10% revenue growth, though.
Okay, let's hear it.
Because the macroeconomic data from this tax season presents a glaring contradiction.
You're talking about the total filing volume.
Yes. We just went through the most chaotic tax season since, like, the post-pandemic normalization period. And total IRS tax filings were down 30 basis points this season.
Right, which sounds small, but...
Let's do the math on that for a second. A basis point is 0.01%. So 30 basis points is 0.3%.
Exactly.
When you apply a 0.3% contraction to a total addressable market of roughly 160 million U.S. taxpayers.
That translates to a contraction of around 2 million tax returns.
2 million.
Yeah.
The entire pool of people filing taxes literally shrank by 2 million units.
It is the most significant industry-wide volume contraction we've seen in years.
Right, and Intuit felt the impact of that contraction directly, didn't they?
They absolutely did.
So explain the underlying mechanism to me then. If fewer human beings are participating in the exact activity that your software is built to facilitate...
How do you make more money?
Yeah. How does your revenue increase by nearly $1 billion? I mean, the pie got smaller, but Intuit somehow took home more calories.
It really comes down to a ruthless, like almost Darwinian segmentation of their customer base.
Darwinian, I like that.
You have to look at the tax market, not as a single monolith, but as two distinct ecosystems.
Okay.
And CEO Sasan Goodarzi, he was unusually candid about their failure in the lower tier ecosystem.
What did he say?
During the call, he stated he was, quote, constructively dissatisfied with their performance in the do-it-yourself or DIY segment.
Huh. Constructively dissatisfied. Yeah. That is excellent corporate jargon for we took a beating and we know it.
Oh, totally. They took a massive beating among the most price-sensitive consumers.
Which makes sense.
Goodarzi explicitly called out the demographic of filers earning less than $50,000 a year who have very simple tax situations.
Like just a standard W-2 form.
Exactly. His exact quote on the call was, "We lost on price."
Well, I mean, that dynamic is completely logical.
It is.
If you're making under $50,000 a year in an inflationary environment, literally every single dollar matters to you.
Yeah, you're not going to pay a premium for the TurboTax brand name.
Right. Not if a competitor or even, a government-sponsored portal offers a perfectly functional, completely free alternative.
Exactly. Brand loyalty just vaporizes the moment a cheaper, viable substitute appears for a commoditized service.
Because filing a basic W-2 is completely commoditized.
It is. And the result of losing that demographic is pretty stark. Overall, TurboTax revenue for the quarter was completely flat.
Wow. Zero growth in the core legacy product.
Zero. Flat revenue on the surface. But underneath, they executed a radical shift upmarket.
Okay, walk me through that.
While they were bleeding out sheer volume at the bottom of the funnel, they were simultaneously capturing massive margin at the top.
It feels like an airline that is actively ripping out the cramped economy seats in the back of the plane.
That's a great analogy.
They're intentionally letting the budget travelers walk over to like a discount carrier. And meanwhile, they are using that extra floor space to install luxury, highly profitable first-class suites.
Yes.
So they entirely sacrificed the volume game, the pure headcount of passengers, but they dominated the premium margin game.
The internal data from the call validates that analogy perfectly. The first-class suites, in Intuit's case, is their done-for-you assisted tax service.
TurboTax Live.
TurboTax Live.
Yeah.
And this is a fundamental departure from traditional DIY software.
Right, because it's not just you typing numbers into a form anymore.
No, TurboTax Live is a managed platform where a human expert, increasingly augmented by internal AI tools, by the way,
of course,
actively assists the user or just takes over the filing process entirely. And the revenue for TurboTax Live didn't just grow, it exploded by 36%.
Wait, 36%?
36%.
A 36% growth rate for a premium service during a season where total industry filings actually contracted.
Let that sink in.
That implies a massive internal conversion rate of existing customers upgrading to the higher tier.
The conversion rate is staggering. Because of that growth, TurboTax Live now accounts for 53% of the entire TurboTax franchise.
Over half.
That is an 11-point jump from the previous year.
So for the first time, more than half of Intuit's consumer tax revenue is generated not by people buying software to do their own taxes,
But by people paying a premium to have an expert do it for them.
That is a massive paradigm shift. Let's break down the economics of that shift, though.
Sure.
Because if over half of the revenue is now coming from a premium tier, the average revenue per user, the ARPU, has to be skyrocketing.
ARPU jumped 11% across the board.
11%.
Yeah. They are witnessing incredibly strong monetization across both simple and complex tax brackets.
Simply because a critical mass of customers is explicitly opting into these high-ticket assisted offerings.
Exactly. And Goodarzi mentioned a shift from complexity-based to value-based pricing during the Q&A segment.
Okay, we need to dissect the psychology of that pricing model, because it's the engine driving that 11% ARPU increase, right?
It absolutely is. Think about the old days of desktop software.
Right. You paid based on the complexity of your IRS forms.
Exactly. A basic 1040 was one price. Adding a Schedule C for freelance income cost more, and adding capital gains forms cost even more.
Which was frustrating, but straightforward.
Well, they are abandoning that traditional model entirely.
Really?
Yeah. Goodarzi outlined a value-based architecture. Under the new model, your demographic and your financial behavior dictate your tier.
Okay, give me an example of how that works in practice.
So a filer earning under $50,000 with a simple W-2 might be funneled into a completely free tier.
To prevent them from churning to a competitor.
Exactly. But the moment that same filer wants to claim a specific deduction like, say, charitable donations or student loan interest,
Oh, I see.
they cross a value threshold and are instantly bumped into a paid tier.
I honestly struggle with the consumer psychology there.
Why is that?
Well, why are these price-sensitive customers, the ones who theoretically left for cheaper options, suddenly willing to pay a premium just because they have one extra deduction?
Goodarzi offered a really fascinating psychological insight on this.
What did he say?
He noted that these specific consumers are entirely willing to tolerate a fragmented, frustrating user experience on a competitor's platform if it saves them $20.
Sure, they'll suffer through a bad UI for a discount.
Right. So Intuit's strategy is not to win a race to the bottom on the basic filing fee.
Then what is it?
Their strategy is to capture the user with a seamless ecosystem and then monetize them through completely different financial vectors.
Ah, and this brings the Credit Karma integration into focus.
Bingo.
Because the strategy isn't just about the tax fee at all. It's about owning the entirety of the user's financial data.
It is a textbook flywheel effect. Management revealed that ARPU is approximately 30% higher for customers who actively use both TurboTax and Credit Karma.
30% higher compared to a user who only interacts with TurboTax.
Yes, and over 35% of all TurboTax customers are now adopting Intuit's Fast Money offerings.
Okay, let's analyze the mechanics of a fast money offering for the listeners.
Yeah, it's brilliant.
When a consumer finishes their tax return and realizes they are getting, say, a $2,000 refund from the IRS.
Historically, they had to wait weeks for the Treasury to cut a check or process a direct deposit.
Exactly. But Intuit steps into that temporal gap. They offer to advance the user that $2,000 immediately.
Depositing it directly into a Credit Karma Money account.
Right. They effectively collateralize the anticipated IRS refund.
Because Intuit knows the money is guaranteed by the U.S. government.
So the risk of default is virtually zero.
Zero. And by advancing the cash, they lock the user into the Credit Karma ecosystem.
Which is huge.
They expect to process and deliver more than $25 billion in refunds through these accelerated money offerings this year alone.
$25 billion. So even if Intuit loses $20 by heavily discounting the upfront DIY filing fee,
doesn't matter. They generate exponentially more value by cross-selling that user into a Credit Karma high-yield account, a personal loan.
Or by capturing interchange fees when the user spends that cash advance on an Intuit-branded debit card.
Exactly. The technical integration pipeline between the two platforms is doing all the heavy lifting here.
And the transcript highlighted that Credit Karma members with simple tax profiles can now have up to 80% of their tax return automatically completed before they even open the TurboTax application.
That is the power of a unified data architecture.
It's crazy because Credit Karma already possesses the user's identity verification, their credit profile,
and in many cases, visibility into their actual direct deposits.
Right. So by scraping and mapping that existing data directly into the TurboTax engine, they remove all the friction from the onboarding process.
And that specific integration drove a 54% year-over-year increase in the number of tax filers who initiated their entire tax experience from within the Credit Karma dashboard.
Wow. If we zoom out and look at the underlying architecture, Intuit is literally no longer a tax software company.
Not at all.
Tax filing is just the customer acquisition vehicle. They have built a comprehensive, closed-loop financial data ecosystem.
Yeah. Going back to our airline analogy from earlier, they didn't just install first-class suites on the plane. They bought the airport. They built an exclusive private lounge, launched their own branded credit card, and set up a concierge service that clips a ticket every time the passenger buys a coffee at the terminal.
That is exactly what they did. And that transition from a single-point software solution to a holistic ecosystem, it's even more pronounced on the business-to-business side, isn't it?
Oh, absolutely. The consumer tax narrative often dominates the headlines because everyone files taxes.
Sure.
But the B2B segment is where the most aggressive operational scaling is actually happening.
Right. I mean, Credit Karma's consumer revenue grew a respectable 15%.
Which is solid.
Solid, yeah. But the mid-market business segment, which encompasses QuickBooks Advanced and the Intuit Enterprise Suite, I mean, those numbers were staggering.
The mid-market segment grew by 38%.
38%. Achieving a 38% growth rate in B2B enterprise software.
During a macroeconomic period where businesses are actively, aggressively cutting software as a service budgets.
It's a complete anomaly. So walk me through the mechanics of how they are penetrating the mid-market so effectively.
They are scaling via brute force sales expansion combined with an expanded product footprint.
Okay, what does brute force mean in this context?
They increased the headcount of their direct enterprise sales team by roughly 30% over the past year.
Wow.
Crucially, though, they are also seeing a significant uptick in individual seller productivity.
Meaning each rep is closing more deals.
Right. So when you combine more salespeople with higher close rates per rep, it translates to the 37% quarter-over-quarter growth they reported in total Intuit Enterprise Suite contracts.
That's incredible. But I want to know what these mid-market businesses are actually buying.
Well, think about the scale.
Right, because a small plumbing company might use basic QuickBooks just to track expenses.
Sure.
But a mid-market enterprise with $50 million in revenue needs far more than a digital ledger.
Exactly.
And the earnings call specifically highlighted that total online payment volume grew by 30%. That tells me this isn't just about accounting anymore.
No, it's not. Goodarzi uses a specific metaphor for this. Intuit aims to be the control tower for these businesses.
The control tower. Okay, break that down.
Imagine an air traffic control tower. It doesn't just record that a plane landed.
Right. It dictates the approach, manages the runway schedule, coordinates the baggage handlers.
Exactly. Intuit is embedding itself into the actual operational workflow of how a business moves capital.
So it's managing the entire life cycle from lead generation to the final cash deposit.
Yes. It handles the accounts payable, processes the employee payroll, and crucially, acts as the payment facilitator for incoming revenue.
Wow. So they are integrating embedded finance directly into the invoicing process.
Exactly. They're offering buy now, pay later options to a business's clients and issuing Intuit business credit cards for corporate expenses.
They are completely transforming. They went from a software vendor that charges a flat monthly subscription fee into a toll booth that clips a percentage of every single dollar that flows through the business.
That's the secret sauce. When you act as the payment processor, you capture the interchange fee.
Right. If a business runs $10 million of invoice payments through the Intuit portal, Intuit just skims a percentage off the top of the entire gross merchandise volume.
Precisely the mechanism at play. And their online payment volume growth, even when you exclude standard bill pay, was an impressive 18%.
And when you fold bill pay back into the equation,
The total volume growth hits that several percent mark.
unbelievable.
They are deeply structurally embedded in the daily cash flow operations of these mid-market companies.
And I bet the data shows that the adoption rates for these payment tools are highest among their most complex, highest revenue B2B customers.
Exactly.
Okay, so we have established a pattern here of immense revenue growth, a completely successful pivot to premium consumer services, and an exploding B2B ecosystem.
The fundamentals appear incredibly robust.
They do, which brings us to the elephant in the room,
Here we go.
the absolute shocker of this earnings call. Intuit announced they are cutting their full-time global workforce by a massive 17%.
1 in every 6 employees is just gone.
Gone. And I'm going to push back aggressively on the corporate narrative here.
Let's hear it.
Because the immediate assumption across all the retail investing forums the moment this news broke was that Intuit finally achieved artificial intelligence scale.
Right, the AI takeover theory.
The narrative is that AI agents are now writing the code, AI agents are processing the tax returns, and management simply fired the expensive human beings. Is that the reality? Did they swap salaries for server costs?
Look, this is the most heavily scrutinized element of the entire call. The Wall Street analysts immediately zeroed in on the exact same theory you just laid out.
I'm not surprised.
Brad Zelnick, an analyst from Deutsche Bank, he explicitly cornered management during the Q&A. He asked directly how much of this 17% reduction was attributable to AI efficiencies.
He wanted to know if we were witnessing a structural shift from human labor to AI compute tokens.
Exactly.
Let's define an AI compute token for a second before we get to the CEO's answer, just so you have the context.
Good idea.
When a company utilizes a large language model, they don't pay a salary, right? They pay for compute power. A token is roughly equivalent to a piece of a word processed by the AI.
Right, like a syllable.
Yeah. And every time an AI agent analyzes a tax document or answers a customer query, it burns tokens, which cost fractions of a cent. Pennies.
So the holy grail for tech margins is replacing a $150,000 human salary with $5,000 worth of AI token compute costs. So did Goodarzi admit to executing that exact swap?
He categorically denied it.
Really?
His response was unequivocal. He stated, on the record, that this workforce reduction was not driven by AI replacing human workers. He explicitly rejected the narrative that the robots took the jobs.
I am highly skeptical of that denial.
I know you are.
I mean, if you are generating record profits, expanding your B2B sales force, and seeing 30% growth in payment volume, why on earth do you suddenly amputate 17% of your workforce if it isn't an AI-driven efficiency play?
It's a fair question.
You don't fire 1 in 6 people when the business is booming,
Right.
unless the underlying technology fundamentally changed how the work gets done.
Well, Goodarzi anchored the justification on organizational design rather than technological replacement.
Okay, what does that mean in plain English?
He repeated a specific mantra. Intuit needs to be a faster, flatter, and more focused organization. Faster, flatter, more focused.
Yeah. Management claimed they spent the last year conducting a deep diagnostic on their internal velocity.
Their internal velocity.
Right. They studied the friction points that were slowing down product development and delaying feature releases.
And let me guess, the diagnostic revealed that middle management was the bottleneck.
That was the primary culprit identified.
Shocker.
They executed a massive flattening of the organizational chart. They deliberately removed layers of middle management to accelerate the flow of information from the executive suite down to the frontline engineers.
And to push decision-making authority closer to the actual product builders, I assume.
Exactly. And in the process of analyzing these layers, they identified a vast number of what Goodarzi called coordination-heavy roles.
Coordination-heavy. Oh, man, that is a brilliant piece of corporate doublespeak.
It really is.
Because in a bloated tech company, a coordination-heavy role usually refers to an employee whose primary daily output is scheduling meetings for other people, managing Jira boards, and creating slide decks about what the actual engineers are doing.
Spot on. It encompasses PMOs, project management offices, business operations analysts, and excess layers of product managers and design leads.
Right.
These are roles that don't write code or directly interface with customers. They exist purely to manage the internal bureaucracy of a massive legacy software conglomerate.
Look, eliminating tech bloat makes complete sense from a margin perspective.
It does.
But stripping out middle management alone doesn't usually equate to a 17% total headcount reduction.
Right.
I mean, what were the other structural drivers behind the layoffs?
There were 2 other massive structural factors. The first is the finalization of the Credit Karma integration.
Okay.
Intuit acquired Credit Karma years ago, but integrating 2 entirely different tech stacks, corporate cultures, and compliance departments, that takes years.
Yeah, that's not an overnight process.
Management announced that the heavy lifting of integrating TurboTax and Credit Karma into a single unified architecture is finally complete.
Oh. Well, once the architecture is unified, you no longer need parallel teams running the infrastructure.
Right.
If you buy a company, you eventually realize you don't need two separate HR departments, two computing vice presidents of marketing, or two independent data engineering orgs. You just consolidate and eliminate the duplication.
Exactly the case here. They identified massive redundancies across the combined entity and eliminated the duplicate roles.
Makes sense. What was the third driver?
The third and final driver of the layoffs was a radical strategic pivot regarding MailChimp.
MailChimp. That is a fascinating pivot point because Intuit bought MailChimp for roughly $12 billion back in 2021.
They did.
It was pitched as like the ultimate marketing engine for their small business customers. What is the new strategy?
The strategy has shifted from aggressive expansion to rigorous margin extraction.
Oh, wow.
CFO Sandeep Aujla provided what was essentially a masterclass in SaaS financial realities.
Let's hear it.
He explained that they are proactively adjusting MailChimp's cost profile to ensure it is commensurate with its current growth profile.
Meaning what?
They are transitioning MailChimp from being a high-growth, heavily funded investment vehicle into an optimized cash flow generating machine.
A pure cash cow.
Exactly.
Let's look at the broader software market context to understand why they're doing this, right?
Yeah, it's important context.
In the current 2026 tech environment, the valuation multiples that Wall Street is willing to assign to a marketing SaaS platform like MailChimp have compressed significantly.
Big time.
The days of being rewarded for growth at all costs are completely over.
Over and done.
If the market won't give you a massive premium for growing MailChimp's top line by an extra 5%, there is absolutely no incentive to pour billions of dollars into marketing and engineering to chase that marginal growth.
Aujla noted exactly that dynamic. Instead of fighting a brutal, expensive war for incremental market share against dedicated email marketing competitors.
Like Klaviyo or HubSpot.
Right. Intuit is going to strip MailChimp down to its highly profitable core. They will run it efficiently, extract the massive recurring subscription revenue, and funnel that free cash flow directly into their higher yield bets.
Specifically, the B2B Enterprise Suite and their AI-powered expert tax platform.
Exactly.
This brings the entire restructuring into focus. They eliminate bureaucracy, they fire the redundant integration teams, and they put MailChimp on a strict financial diet.
Yep, that's the playbook.
The obvious question for you as an investor is, where does all the capital saved from these thousands of salaries go?
Goodarzi was transparent about the capital reallocation. The lion's share of the savings is flowing straight to the bottom line to drive margin expansion and aggressively boost earnings per share.
Straight to the bottom line.
Yeah. A secondary, smaller tranche of the savings will be reinvested into scaling their proven growth engines.
The assisted tax tier, the fast money credit products, and the mid-market enterprise sales force.
Right. But he noted that those growth engines are already relatively well-funded due to internal productivity gains. So the bulk of the layoff savings truly is pure profit capture.
You know, usually when a legacy company announces a 17% workforce reduction, the market interprets it as a deeply defensive maneuver.
Oh, totally.
It is traditionally a signal that management is battening down the hatches, preparing for a macroeconomic recession, or reacting to a catastrophic drop in forward demand. Did Intuit signal any kind of impending doom in their forward projections?
They signaled the exact opposite.
Really?
This is the detail that truly separates this earnings call from a typical restructuring narrative. They didn't just meet their current quarter targets, they actively raised their financial outlook for the full fiscal 2026 year.
Okay, walk me through the mechanics of the raised guidance. What are the new expectations?
Management raised their total revenue expectations to land between $21.341 billion and $21.374 billion for the full year.
That is a massive number.
It represents a deeply healthy 13 to 14% annualized growth rate.
Sustaining a 13 to 14% top-line growth rate while simultaneously amputating nearly a fifth of your workforce requires extraordinary operational confidence.
It really does.
What about the profitability guidance?
The bottom line guidance is where the margin expansion strategy really crystallizes. They raised their non-GAAP EPS guidance to a range of $23.80 to $23.85.
That's huge.
That translates to an 18% growth rate in earnings per share.
An 18% growth in EPS is the holy grail metric that institutional investors demand.
It is.
And looking at the immediate horizon, their guidance for the upcoming Q4 specifically calls for 11 to 12% revenue growth.
Right. So they are explicitly telling the market that there is no macroeconomic slowdown visible in their internal data.
The momentum from the B2B mid-market and the premium tax tiers is expected to just accelerate.
Exactly. And the confidence extends beyond just the verbal guidance. We really have to analyze their capital allocation strategy here.
Okay, let's get into it.
Because management is making massive, tangible commitments to shareholder returns. CFO Ojala stated on the record that Intuit is committed to delivering annual EPS growth in the mid-teens for the foreseeable future.
And they are deploying their balance sheet to guarantee it, aren't they?
Oh, absolutely.
Let's dissect how they are guaranteeing that EPS growth through share repurchases, because this is critical.
Yeah.
They repurchased $1.6 billion in stock during Q3 alone.
Just in one quarter.
That is more than double the amount of stock they bought back in the exact same quarter last year.
And looking at the wider time frame, across the first 3 quarters of fiscal 2026, their total share repurchases are up over 60% compared to the prior year.
That's aggressive.
Extremely. And they can afford this aggressive buyback cadence because their balance sheet is an absolute fortress right now.
Give me the numbers.
They finished the quarter holding $6.8 billion in cash and short-term investments, weighed against only $6.2 billion in debt.
So they are net cash positive.
They are.
The mechanics of a stock buyback are so vital to understand here if you're an investor.
Let's break it down for them.
When Intuit takes $1.6 billion of its own cash and buys its own shares on the open market, they retire those shares. This permanently reduces the total number of outstanding shares in existence.
Right.
And earnings per share is simply total profit divided by total outstanding shares. So by aggressively shrinking the denominator, the number of shares, they mathematically force the EPS number higher.
Even if the actual raw profit remains static.
Exactly. It is a highly efficient way to manufacture value for the remaining shareholders. And alongside the buybacks, they also approved a $1.20 quarterly dividend,
Which represents a 15% year-over-year increase.
The signaling to the market here is unmistakable.
It's loud and clear.
By combining a massive, accelerated share buyback program with a double-digit dividend increase, right on the heels of a ruthless restructuring aimed at margin expansion management, is broadcasting a very specific message.
They are telling Wall Street, our core operations are throwing off immense amounts of free cash flow. We have conquered our internal bloat, and we fundamentally believe our current stock price is deeply undervalued relative to our future earning power.
Man, we have covered an immense amount of ground today.
We really have.
We analyzed the headline beats, the massive shift from complexity-based to value-based pricing, the Credit Karma data flywheel, the B2B payment processing goldmine, the realities of the MailChimp cash cow, and the brutal calculus of a 17% workforce reduction.
It's a lot to process.
It is time to distill this down into a concrete thesis. Based on the raw data, the transcript commentary, and the macroeconomic context, are we taking a bullish or bearish stance on Intuit's forward trajectory?
Analyzing the structural pivot and the sheer velocity of their cash generation, this report is undeniably a bullish signal for profitability.
Bullish.
Intuit is executing one of the most difficult maneuvers in corporate strategy. They are proving they can extract massive, accelerating profits out of a mature and, in terms of raw user count, actively shrinking legacy user base.
It is a brilliant, ruthless high-wire act.
It really is.
They are successfully managing the incredibly dangerous transition from a mass-market, low-margin DIY software vendor into a high-ticket, deeply integrated financial advisory and B2B enterprise platform.
That is the bullish thesis in a nutshell. However, a responsible analysis demands we look at the structural long-tail risks.
Let's play devil's advocate.
Retail investors need to maintain a healthy skepticism regarding the long-term optical damage of aggressively bleeding out their low-end market share.
The risk is the destruction of their top-of-funnel customer acquisition pipeline.
Precisely.
If Intuit continues to forfeit the under 50K simple W-2 filers to free government portals or discount competitors, they are effectively shrinking the pool of future premium customers.
That's the math.
The college graduate making $40,000 today, who requires zero assistance, might be a small business owner making $250,000 with complex K-1 forms 5 years from now.
And if that user builds their brand loyalty and data history with a competitor when they are young and broke,
what is the incentive for them to switch to the expensive TurboTax Live tier when their financial life finally gets complicated?
that is the exact vulnerability analysts fear. Goodarzi attempted to address this directly on the call, revealing that they have a durable long-term plan to recapture those highly price-sensitive customers.
And what's the plan?
The strategy relies on pivoting away from upfront filing fees entirely for that demographic, instead monetizing them purely on the back ends through Credit Karma financial products.
Right. But a strategy is only as good as its execution.
Exactly. They're operating on a razor's edge. They have to definitively prove they can halt the customer bleed at the bottom of the funnel without compromising the explosive margin growth they are achieving at the premium tier.
Here is the actionable takeaway for you, the investor. If you are currently holding ticker symbol INTU, or if you are evaluating it for your portfolio, you must completely discard your legacy mental model of this company.
You have to.
You are no longer investing in a seasonal tax software company that sells a digital calculator once a year.
You are evaluating a closed-loop enterprise financial platform.
Exactly. You are investing in an enterprise platform that has proven it can successfully upsell small businesses into payment processing tools and convert standard taxpayers into highly profitable subscription-style managed service clients.
Which is a whole different ballgame.
The 17% workforce reduction, regardless of the PR spin about middle management versus AI, combined with the accelerated multi-billion-dollar share buybacks, proves one thing definitively. Management is hyper-focused on engineering maximum earnings per share.
They are pulling every available financial and operational lever to forge a leaner, faster, and exponentially more profitable machine.
They are executing this massive restructuring from a position of profound financial strength.
As Goodarzi noted, they are, quote, fixing the roof while the sun is shining, rather than waiting for a crisis to force their hand.
Before we close the book on this deep dive, I want to leave you with one final provocative thought to chew on.
I like provocative.
This is a dynamic that builds on everything we have unpacked today, particularly the AI token discussion, but it is a conflict that was noticeably left unresolved on the earnings call.
Let's lay out the paradox.
Intuit is currently generating the vast majority of its incredible consumer revenue growth by convincing legacy users to abandon the cheap DIY software and upgrade to TurboTax Live.
Right.
The entire branding, pricing power, and value proposition of that premium tier is anchored on the presence of human experts.
You pay top dollar for the peace of mind that a certified human professional is handling your taxes.
But simultaneously, behind the scenes, Intuit is pouring billions of dollars into developing autonomous AI agents. Management proudly touted on this very call that their AI architecture is already generating predictive recommendations across 50 million discrete financial transactions every single week.
The internal AI agents are rapidly approaching a level of sophisticated competence where they can autonomously execute the exact same complex workflows that the premium human experts are currently performing.
That is the collision course. Here is the question you have to ask yourself as an investor looking 3, 5, or 10 years down the road. What happens to Intuit's magnificent premium pricing power when the live expert the customer is paying hundreds of dollars for is quietly replaced by a back-end AI agent that costs Intuit fractions of a cent in compute tokens to operate?
It's the multi-billion-dollar question.
Will consumers continue to willingly pay first-class human-tier prices when they inevitably realize the pilot flying the plane is just a localized language model?
If they rebel and demand software tier pricing, Intuit's margins just collapse.
But if Intuit can successfully maintain the premium illusion and charge human rates for AI labor, they might just capture the greatest margin expansion in the history of consumer software.
That is the ultimate existential paradox of the impending AI era. Right now, Intuit is selling human confidence, not just code.
But in the near future, the code might be the only thing providing the confidence.
And the market will dictate whether they can charge a premium for the invisible machine.
We will see how the cards fall at the highest stakes table in fintech. Thanks for joining us for this deep dive into Intuit's strategic masterclass. Keep dissecting the data, and we will catch you next time.